Now, when it comes down to tax strategies, there are a number of things that you can look at. And what we're going to do is we're going to go through a couple in this. And the ones that we're going to cover are going to be, incorporations, to where there's certain incorporations or ways that you can incorporate your business and aspects of that will present a tax benefit. We'll go through S corporation election. We'll go through limited liability companies. We'll go through LLCs or limited liability companies being taxed as an S corporation. We'll also talk about deductible expenses, and then we'll talk about making your business a family business. And we'll explain that a little bit more. So when we look at incorporation, a couple of things we want to keep in mind is that based on the current tax code that's in fact in place for 2020, when it comes down to pass-through entities, now pass-through entity is simply a business structure that allows the profits of that business to pass through and to be taxed on your personal tax return, which means the corporation itself or the company itself doesn't pay income taxes. All of the profits get distributed to the owners or the members or the partners of the organization. So think about, partnerships, and also think about, S corporations, and think about LLCs, because the profits do not get taxed at the business level. They get passed to the actual owners of it. Now, with that pass-through entity, there is an exclusion where the first 20% for businesses that qualify will be, I guess they call it a QBI, qualified business. It's a qualified business income deduction, to where you get to exclude the first 20%. Now, this only applies if you're incorporated. So if you're running your business as a sole proprietor, this won't apply to you because you're not a pass-through entity. You're not a pass-through structure, which is why I say, just incorporating your business could help you to start reducing your taxes legally. Now, the other thing about incorporating is that your expenses and can offset some of your revenue, because when you're running your business as a sole proprietor, you're selling some stuff, you have some expenses related to that, and you can fill out a Schedule C. But you incorporate your business, what you can start to do is, you really have an organization to run. Like, your business is a separate entity, which means there are going to be more costs, there are going to be more expenses that you can include in your business to offset your income. So some of the things that you may normally do in your daily life, you can start to include those as legitimate business expenses to offset some of the income, which also helps you reduce your tax liability. And then when we look at some of the factors you should consider when it comes down to incorporation, is that incorporating, there is a process to it. So it's not just as simple as you just woke up one day and you just said, hey, I'm now incorporated. You do have to file some paperwork, and you do have to get some things filed, whether that's with the state or with the federal government, depending on the type of, incorporated structure you want. Now, if you want a little bit more details on the types of structures, you can definitely take a look back at our course that we did on all about your corporate structures, where we went through all the corporate structures and we go in detail in that. So you kind of understand, hey, which ones might be a good fit for the type of business that you have. And then the next thing you want to look at is, if you're going to select a structure, you want to make sure that you have proper legal and tax support, because you don't want to pick a structure that's not going to be in your best interest. So it's not as simple as just Googling it and just saying, hey, I'm just going to pick this one. You want to make sure you understand the rules about it. And then also, when it comes down to, picking the type of business and incorporating your business, you want to make sure that you are making the right business decision and not just a tax decision. Because that's where a lot of people get into trouble, is where they look at a situation and they say, well, I'm just going to make the decision that saves me the most in taxes. But they don't look at, hey, how much work is that going to put on you? How much additional paperwork does that add? What other type of business restrictions does that put on you? And if I guess you say, the cost to your business or the extra work to your business is actually going to be too strenuous, it might not be the best decision. So you want to make sure that you're looking at this to make the best decision, not just what's going to reduce your taxes. And then the next one is going to be an S corp. Now, an S corp is a type of corporation. So think of like a small corporation. Now, the benefits, as we mentioned in the first one, are the pass-through exclusion, because the S corp is not taxed as a separate entity. The income and the profits left over get passed to you as an owner or split between the owners. So you get that pass-through exclusion at 20% we talked about. But you also get another benefit with an S corp, is that, the net profits for the business are not subject to self-employment taxes. Now, what self-employment taxes are, like, your FICA, your FUTA. So it's about 15%. So if you think about that, I mean, the compensation that you get, take, whatever that profit is times 15%. And that would be, what your employment taxes are, if you're self-employed. Now, think about that. If you made, let's say, $10,000 in net profit, if you multiply that by the, roughly 15%, I mean, that's $1,500 of savings if you were a legitimate S corp, because you would be able to exclude that for that portion coming to you. Now, those are great benefits. But again, there are factors that you need to keep in mind, because we need to make sure we're making a business decision, not just a tax decision. Now, when it comes down to S corp, there are higher fees involved when it comes down to filing your taxes, because although the S corp is not taxed as a company, you do have to file an information return with the IRS. So the IRS wants to know, hey, how did your S corp do? And then whatever was left over, those profits get distributed. So you do have to file an extra form when you are an S corp. The other thing is, there are some limitations when it comes down to S corp. Now, to be classified as an S corporation, there are some limits about who can actually be an owner of an S corporation. For example, if you're a foreign party, so I'm in the US, so if you're outside of the US, that you may not be allowed to be an owner of an S corporation, or it may be limited to just 100 different owners. So you couldn't have 1,000 people owning this S corporation. And then also, if you are a C corporation, you can't be an owner of a percentage of an S corporation. And that may sound confusing, but when you think about it, a lot of times, there are businesses that own a percentage of ownership of another business. So it's a common thing. But when you're looking at an S corp, because of the rules, you can't have C corporations that own a portion of an S corp. And then also, there's only one class of stock. So when it comes down to a S corporation, you do have to issue ownership in the form of stocks or shares. So the owners have a X number of shares or X percent of the company. And when it comes down to your S corp, there's only one class. So you can't do a common and a preferred. And usually companies or your C corporations may do that if they want to, adjust, whether it's voting rights or they want to give people preference on distribution of profits. But with an S corporation, there's only one form. Now, these rules are important because if you are an S corporation and you violate any of these rules, you immediately lose your S corporation status, and then the IRS will tax you as if you were a C corporation. And what we talked about in the corporate structures class is that C corporations go through double taxation, meaning the company has to pay taxes on its profit, and then the owners will have to pay taxes if the corporation decides to distribute the money. So there's two taxes on the same amount of money if you're a C corp. So you want to make sure you keep in mind what these rules are. And then the last one is within S corp, because there are special rules and special privileges, there are some rules you need to keep in mind, or some additional rules you need to keep in mind. One of the big ones is that, with an S corp, that the owner is required to be set up as an employee and to receive a reasonable salary. Now, the IRS doesn't specify exactly what reasonable means, which is why you're going to have to work with your tax attorney or your CPA to understand, hey, what would a reasonable salary mean for the owner if you wanted to go the S corp route? And then also, you need to be a little more formal about how you run your business. I mean, whether that's, doing annual meetings, meeting with your board of directors, also, keeping minutes for those meetings. So, because you're really running a small corporation, so you want to treat it like a very, very legitimate business that is separate from your personal life. So you got to be a little bit more formal when it comes to an S corp. Now, the other tax strategy that people use is a LLC. Now, an LLC, or a limited liability company, also gives you flexibility because you can be taxed as a partnership, a C corp, or an S corp. So in this point, we're going to just talk about if you chose to be taxed as a partnership or a C corp. So this is a pass-through entity. If you're a partnership, it'll be a pass-through entity, which means you'll get that 20% exclusion based on the current tax code. If you're a C corp, you won't get that. If you're a C corp, it won't be pass-through. You'll have to pay taxes at the corporate level, and you'll have to pay taxes if you distribute the profits to the owners. Now, some of the factors to think about with an LLC are, depending on the structure you pick, there are some higher fees to pay when you're filing your tax returns. Also, if you choose to be taxed as a partnership as a partnership, you're not going to get that self-employment exclusion. The biggest benefit you got from being an S corp is you don't have to pay that additional 15% self-employment taxes. But if you do it as an LLC, and you are being taxed as a partnership, you will have to pay that self-employment taxes. So that $1,500 that you saved before when you made $10,000 in net profits, now you're going to actually have to pay that to the IRS because self-employment taxes will still apply. Now, another thing to keep in mind is that there are going to be additional records required when you are a limited liability company. I mean, this is, like I said, when you were a sole proprietor, it was way less formal, but you didn't have some of the tax advantages. But if you are going to be an LLC, you are going to have to keep more records than you would have if you were a sole proprietor. And then also, if you elect to be taxed as a C corporation, which means you'll get the benefits of a C corporation, which you can go back to the corporate structure class where we talked about a C corp and we talked about all the benefits of being a C corp. But you'll get the benefits, but you'll also have to deal with the double taxation, where the corporation pays a tax, and if you distribute the money, that the individuals will pay a tax as well. Now, if you choose the election for an LLC or a limited liability company and say, hey, I am an LLC, but I want to be taxed as an S corp because I want to avoid paying the self-employed, or legally avoid paying the self-employment taxes on the profits that's left over in the business. That's very possible to do. Now, one of the benefits you may say is, or I guess a question you may have is, okay, if I can just elect to be an LLC and elect to have it taxed as an S corp, what's the difference between being an LLC taxed as an S corp and just being an S corp? Well, one of the big differences comes down to some of your state laws, because if you are an S corp, there are some, stringent laws or some very clear guidelines and a little bit more formality and structure around the laws that apply to an S corporation. If you are an LLC, for the purpose of, like legality in the state, there you may not have some of those stringent rules that you would as an S corp. So you'll still get, like I said, some of the tax benefits of not having to pay the self-employment taxes, and you get a little more flexibility on some of the rules. Now, when it comes down to, things you need to consider, because you are choosing to be taxed as an S corp, you will still have to file that information return for your organization. So your tax filing fee at the end of the year with your CPA or your tax attorney is going to be a little bit higher. And also, you still have to meet all the requirements of an S corp, meaning no foreign owners, only one type of stock, and then also no C corporations can own the business. And then, like I said, you're only limited to, I believe at the time, it's 100 or less owners of the company. And then you'll definitely need to keep cleaner records because you'll need to conduct it like it is a small corporation. Now, another very big area when it comes down to tax strategy is the expense side. When it comes down to, conducting your business, legitimate expenses that are involved with running the business are actually deductible. They can reduce your income for the purposes of taxes. And, this is an area that a lot of business owners, especially those that are just starting out, that they tend to struggle with at times because there are some things that they're just not tracking. For example, when it comes down to, let's say, your lodging, your traveling, those costs that are related to conducting your business, you should keep track of those because they are deductible expenses. Now, one of the areas that, people ask the question or people get a little concerned on is when it comes down to lodging, because they're like, well, how do I really do this cleanly? Because I don't want to mix things up between my personal life and, my business life. And because this is an area where some people do find themselves getting in trouble because they start to blur the lines between their personal life and their business life. And so one of the things that I recommend for a lot of people is when it comes down to your travel that you're doing for your business is start to be a little clearer about what the purpose of that was for. Let's say if you're in business with, another person or whatever, and you know what, you can actually just, if you're going on a trip for business purposes, just follow up with an email and just say, hey, I'm going on this trip. This is what my agenda for the trip is. Because then you can start to provide a little bit more legitimacy and a little bit more explanation as to what the trip was for. Because I get this question sometimes when, there are, business owners, they're like, I'm going on this trip or I'm going to hang out with some friends or whatever, but I'm going to use my business credit card. So that makes it deductible. Not really. I mean, just because you're using your business bank account doesn't mean that it's actually business related. It has to be something actually related to your business. And you can work with your CPA to figure, out what your specific approach is, but you want to make sure that it is, related to conducting your business. And you want to be very mindful not to blur the lines too much. I mean, because if you start to blur the lines, there could be some negative ramifications and penalties that come with that. Now, when it comes down to meals and entertainment, now this is an area that becomes a little tricky at times because, when you think about meals and entertainment, if you think about, if you're buying food for the staff, I mean, whether you're buying food that goes into the office and it's for the staff, or, you're taking a client out, or in cases where you're hosting an event and you pay for catering for the event. Now, when it comes down to meals and expenses, based on the tax code, they're only deductible up to 50%, except a big exception to that is when you're buying food for an event that you're holding. In those cases, typically the meals and the cost of the food and the service is deductible 100% when it is supporting a business related event. Now, when it comes down to what I've seen with a lot of business owners is, again, they say, well, I'm going to grab some food for myself on the way home, and I'm going to use my business card, so that makes it deductible. Again, it's not whether you use your business card or your business credit card or your personal card. It's how is this related to the business? How is this related to conducting the business? And then when it comes down to a couple of other areas, like your technology, software, and then the expenses for your home office, you want to keep those in mind and track those and have a conversation with your CPA to understand, hey, what technology costs, like my phone, my internet, different things like that. Or even when it comes down to software that you're buying on your computer, or things that you're working on, whether it's antivirus software, or whether it's, whether you're using like Microsoft Word or these different software programs. Like right now, I mean, the program that I'm using to record this I guess you say this course, or the camera, the lights, and everything, like all of those things are part of conducting the business that I am in. So you want to keep track of that, and you want to keep a good log or a good idea on those things, because that's an area where a lot of people tend to lose potential, deductions that they could be using to offset income, but because they're not tracking it and they don't really think, well, I didn't know that was business related. So you want to make sure you have a very clear conversation with your CPA or the person that you're working with to file your taxes, to understand, hey, what deduction or what types of expenses do I need to be keeping track of to make sure that I am good in this area? And then the same thing comes down with your home office expenses. There are some deductions for, your home office. So you want to make sure that you have that conversation with them to understand that. Now, another big area where I see is you can make your business a family business. Now, when I say a family business, some people may think of, like a little mom and pop shop. I'm talking about in the sense that if you're giving money to family members, instead of just giving them money and you having to pay taxes on it, what you could do is you could actually hire those family members in your business. Now, where I see this happen a lot are people who have children. Let's say you have children under the age of 18. You can actually hire your kids as employees in your business, and you can pay them a salary, or you can pay them a wage for the work that they're doing. Now, the reason why that becomes a effective tax strategy is typically your children are going to have a lower tax rate than you do. And if the income that they are getting is earned income, because there is a very big difference between earned income and unearned income, but if it is earned income, then you are probably qualified to be able to deduct it. Now, you want to make sure that you are, working with your CPA to understand, are you doing this within a reasonable range? Because you can't pay your children a ridiculous amount for something that just doesn't make sense. That's going to drive red flags for the IRS. So you want to make sure you're doing it reasonable, like you're paying them a reasonable wage for the type of work that they're doing. Now, you may be thinking, okay, well, what type of work do they have to do? I mean, it can be anything. It could be, if you have a home office, it could be taking out the trash and cleaning up and making sure, hey, the office stays in order, or working on your social media accounts, or creating flyers, whether you use Canva or some type of editing software, doing things like that, or making phone calls or emailing clients invoices. Different clerical things like that, or different things around the office, can be very legitimate tasks that your children can do. And you can start to get your children involved in the business, and you can pay them a reasonable salary or a reasonable wage. Because what I've seen a lot of people do is they hire their children in their business, and what their children can then do is, let's say, your children have fees at school for the sports that they want to play in. Well, when you hire them in the business, instead of you paying the fees directly yourself, you can hire them in the business. You can pay them a salary for the work that they are doing in the business, and then they can pay their school fees themselves, which allows you to get a tax benefit because their tax rate is probably going to be lower than yours. Now, there are a couple of things to consider when it comes down to this. The first one is the work they are doing has to be related to the business and has to be, some legitimate business responsibility. I mean, they can't be doing something completely unrelated that has nothing to do with your business, because that can get you into trouble. The other thing you want to keep in mind are the kiddie tax rules. This is where I was talking about the difference between earned and unearned. So earned means they're actually doing something and the money is just compensation for the work they're doing. Unearned would be things like dividends or interest, where there's money put in an account and they're not really doing anything, but the money is being made and the money is being, let's say, collected in their account. Now, when it comes down to unearned income, the IRS does have some limitations around unearned income, to where if the unearned income exceeds a certain amount, the IRS says that you as the parent have to take that income and include it on your tax return. So you want to make sure you understand that and you don't get mixed up with that. And then also you want to consider, for a child that is under age 18 or under, you got to think about covered services, because now the benefit for this is that children that are under the age of 18, they're not subject, or the income and the wages that they're paid for earned income is not subject to FICA and FUTA taxes, which it's a benefit, because again, as we talked about, with the FICA taxes being something like 15%. So that's a reduction in the amount of taxes you would have to pay on that income if you meet that criteria. And then also, if your child is under the age of 21, or let's say, if they're between 21 and 18, they're 19, 20, or 21, then their earned income is not subject to FUTA tax, which isn't as much as 15%, but any type of tax savings that you can get, I mean, it makes sense, because there you have two benefits. Money that you would have paid at your higher tax rate, you're now paying to your children, so it's going to be taxed at a lower rate, and it's excluded from FUTA taxes, which means that's more money that they get to keep in their pocket. That's less money you have to write to the IRS. Now, one of the recommendations that I give to a lot of people, if you're going to go this route, you want to be clear about what they are actually doing. You want to make sure that you're keeping records about this. You don't want to just go off and just say, hey, I'm paying my children, and you don't have records about what are they doing and how it's related to your business. So there you have it. Those are the common tax strategies that business owners use to legally reduce their tax liability. That's going with the proper incorporation, that's using an S corp, or being in a limited liability company, or a limited liability company taxed as an S corp. And also keep in mind all of the deductible expenses that you are eligible for. Like, don't lose sight of those, because there are tons of people who aren't taking the right level of expenses, which means they're paying taxes at a level higher than they need to. And then also making your business a family business, where you hire employees from your family. And one of the obvious ones to do is, if you have children, is hiring your children to work in the business, because their tax rate is more than likely going to be lower than your tax rate. And if the child is under the age of 21 or 18, that income that you pay them could be excluded from FUTA and FICA tax, which means even more savings. Plus, it teaches your kids responsibility, and they can probably start covering some of their own costs if you're legitimately taking care of that.